the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we're talking about supplemental executive retirement plans. Across the community banking space, a percentage of executives have a supplemental retirement plan. So something that goes beyond your 401k or your simple plan. These plans are set up to try to, more or less, I believe, incent executives to stay. So today we've got Rick Boothby from Acumen, and Rick is going to walk us through this. I wanted to learn a little bit more about these because I've been to plenty of Bankers Association events, and it always seems like there's a few folks out there selling the plans. So I thought we'd try to get the positives and negatives of them and see if we can learn something today. So without further ado, let's join Bank Talk. Okay, welcome back to Bank Talk. Today I have with me Rick Boothby, who is the Vice President at Acumen. Rick, so we're here to talk about supplemental executive retirement plans. Can you just give us a feel for, what does that mean? I think most of our listeners probably, some of them may be aware, but I don't know that all of them are. So would you just give us a feel for what these things are and who they appeal to, that type of thing?
Sure, Charlie. A supplemental executive retirement plan is exactly what it says, to supplement the retirement benefit for a key employee, a key executive. It's a non-qualified plan, meaning that you can pick and choose as long as the individual is in key management position. It's the opposite of a qualified plan. A qualified plan has all the restrictions that deal with that qualified plan as far as contribution limits, benefit limits. So a non-qualified plan is freedom for the organization to draft and design their benefits specific to that key employee.
Now, this kind of resonates with me pretty well because we just oddly switched our I guess it'd be our qualified plan, from a simple to a 401k, a different 401k provider, right?
Yeah.
And in there, the rules, there's a lot of rules. Who, if you're as a company, if you're going to match 3%, let's say, as an employee, I'm gonna contribute 3, employer matches 3. There's a whole bunch of rules around who can get more than 3%, right?
Correct.
And there's just a ton of rules around them. Well, I think what you're saying, though, on the supplemental side of it, as you think of these non-qualified plans, this is another way to incent one of the execs that maybe can get outside of the restrictions of the qualified plans. Do I understand that correct?
Absolutely. And for that reason, it's used, the benefit plan is used, the non-qualified plan is used to recruit, reward, replace benefits that are lost from that qualified plan, retain and actually retire an individual from a credit union.
So, Rick, give us a use case or something you can walk us through. Because I think of it this way. You've probably got younger execs, maybe in their 30s, 40s, and their gap between there and retirement is a longer term. And then you have an exec who's probably older, and her gap might be something like shorter time period. Do you take a look at Social Security plus whatever they've saved up in 401k and try to hit the whole gap? Or, is there some balance between I'm going to try to save 100%, to get you to your 75% number and keep you around, right? Like there may be a big difference when you're 55 years old or 58 years old, right? Because that time between there and retirement is shorter and shorter. So I'll stop there.
Okay. I'll give you 2 examples here. Let's take the 45-year-old first. The 45-year-old has a qualified plan. The qualified plan allows him to contribute 10% of his pre-tax salary, and the employer matches it 50 cents to $1. So the 45-year-old salary at 150,000, retiring at age 62, the target benefit of 80% for that individual would be $120,000. So when you take the qualified plan, add it to the Social Security, that is giving that individual 52% of their final salary. And again, the target is 80%. So we know that we have to fund the difference between the 52 and the 80%. And it's easy to do on a 45-year-old because we've got 17 years to do it. It's a no-brainer. It's very easy to do that with credit union-owned life insurance or corporate-owned life insurance. So now let's take the next individual who is 62, closer to my age. The 62-year-old is being recruited away from 2 or 3 credit unions that they've been very successful at, and they're bringing this individual into the credit union as a new CEO, a new chairman of the board. This individual is making $300,000 a year and only has 5 years to build up 80% of final salary. The retirement gap is actually, in this case, 174,000. So what we've got is we've got an individual age 62 that their qualified plan in Social Security is going to generate 23% of their final salary. Whereas to get to the 80%, we're going to have to fund 174,000 a year to be able to bring that executive up to 80% to be equal with the key employee. Does that make sense?
It does. Yeah, that's a great example. Because again, when I talk about that exec and you say, okay, I got to fund 175 a year, or the current board might say, I don't know that I care to get them to 80%, right? Maybe I want to fund 80 of that, or half of the 175 or something. That might be
That's
enough,
right.
right? Like,
Yes.
so I would imagine anybody making the decision has to determine, based on where you are in your life and how much you saved over time,
Yep.
how big that gap is, and then decide how much of that you want to actually cover. Right.
And how bad you want to bring that person on.
Okay. So then the other question I have there is retention. Let's take the younger person. She's 45 and she decides to leave the company a couple of years down the road. Is this an all or nothing? Like she has to stay to 62 or
Yes.
0, or how does that all?
Yes.
How does that?
Yes. The way it typically is designed in a credit union is that we're coming up, the board and the executive committee comes up with a target benefit that they feel is a retention tool, and 80% would be a retention tool for that individual. So when the individual is thinking about leaving the credit union, they have the same numbers that we're talking about. They know that 52% of their retirement is going to come from qualified plan and Social Security. They're thinking, I might not get Social Security, but I know I'll get the qualified plan. So that's going to drop it down a little bit more. So what is the retention tool is the retirement gap that we're going to fund. So she would walk away from 42,000 a year if she decided to leave the credit union. So the idea with this individual is to have her be retained with what we call a golden handcuff, that the benefit is too good for her to walk away. And that's what you want. Now, the credit union might decide that the individual didn't work out and they can fire her tomorrow and she won't get any benefit. Or if the individual decided that she wanted to go into another industry and do something, she had done a great job at the credit union, they can actually pay a benefit out, a reduced benefit out, to reward her for what she did at that credit union. It would just be reduced.
Okay. Does that decision get made at the time you set the policy? I'm sure there must be some rules around these things, right?
You can amend. Everything is dictated by a plan agreement, a legal document. So when a plan is put together, the legal document is drafted to handle all of the what ifs and what happens when. So if you wanted to increase the benefit for an individual a year after the plan was in, then you could amend the plan. you could increase the benefit, and then you'd have to do an analysis on the funding to make sure that you had enough funding to cover that increased benefit.
Right. But if you were just saying, I'm going to give her a 10-year window and pay something out at 10 to keep her here for 10 years rather than 17, right? Or whatever, right?
Yeah.
That can be amended throughout. I
Yes.
mean, it wouldn't change the dollars probably, right?
Yes, it can definitely be amended.
Okay. All right. I think that answers a lot of the questions I had as far
Yeah.
as how these things work. Give me a feel for what percentage of banks and credit unions have plans for their executive team. And, maybe we use 500 million in assets.
Okay.
How many execs have these plans and how many do not?
Well, let's start with the banks. The banks have been implementing non-qualified plans, SERPS, since the mid 80s. And the banks have really saturated. Just about every bank has a non-qualified plan. But when you look at the top 50 banks, 86% of the top 50 banks have SERPs, and they're using bank on life insurance to informally fund that to the tune of about 170 billion in cash surrender value in those contracts. When you go to the credit unions and you look at the credit unions, let's say in the range of 250 million to 750 million, you have roughly about 60% of the credit unions have a non-qualified plan in that is funded, informally funded with credit union owned life insurance. Now, the majority, big percentage of that 60% is the top tier. What is missing in the credit union world is there is a lot of opportunity for middle management to be included in a plan because historically in credit unions, the plans have consisted of maybe the CEO and sometimes the CFO, but in most cases, just the CEO without including the rank and file management team.
Okay. So let's talk about that dynamic a little bit. I would imagine in the CEO and the board, there's always a conversation going on about, whether he or she is worth, right?
Yes.
You're paying him 250 and he feels he's worth 300 because he brings you a salary survey every year that says everybody makes more than me. Right.
Right.
So I'm guessing that conversation goes on in every board in
Yep.
some way, shape, or form.
Yep.
Now it's time to ask for an executive retirement plan, a supplemental one, right?
Right.
Is it generally, and again, I'm kind of asking about your sales cycle, but are you selling this to the board or to the senior exec, or is it push up from the CEO to the board, or push down from the
Well,
board to the CEO?
well, the way it typically happens is the CEO reaches out to the consultant and says, "I'm interested in making a recommendation to my board to put a benefit plan in. I need justification. I need static data. I need good information that will justify me putting the plan in." And so typically what happens is we move from the executive, the CEO, we move to the chairman of the board because ultimately the chairman of the board is going to make the recommendation to the board to move forward with a benefit plan for that CEO. So the chairman is the key person. Now, following the chairman, the next key person is going to be the chief financial officer and the outside auditor. Because before the chairman will go to the board, the chairman wants to be able to say to the board that we're able to put this benefit plan in, providing 80% of final average salary, and we're able to do it without an impact to the income statement. We're able to do it with a full cost recovery of all benefits. And that has to be explained by the CFO and the outside auditor. And what the outside auditor usually says to the board is that we have reviewed all the numbers, we've reviewed the plan documents, we've reviewed the benefits that are being paid out, the obligation, and this plan is self-funded in the sense that the credit union is not going to lose any money paying out these benefits.
Okay. So now let me stop you there because I think is important for the audience to understand. I would think that the reason that can be said is because the investment in one of these plans is done in a more aggressive style than where the rest of the investments of the bank or credit union are able to go. Meaning there's some
Correct.
regulatory requirement about what they can invest in. This is a little more aggressive, but because it falls under this SERP label, you have the ability to invest more aggressively, and therefore the difference between an aggressive and a non-aggressive, that gap,
Yep.
some combination of benefit to the employee and fees to fund the program, right? Do I have that right? Am I making that up?
It's close. Let me just kind of give you the lay of the land here. In 2006, NCUA passed 70119. And in 2006 was the first time that the NCUA came out and said a credit union can purchase what's called otherwise impermissible. Impermissible is the opposite of permissible. So impermissible investments were defined as credit union-owned life insurance, securities, and annuities. Those are the only three vehicles that can be used to informally fund a non-qualified plan.
Okay.
We'll be right back.
Is your technology spend getting a little out of hand? Are you worried about making those big strategic moves because of those hefty vendor contracts? Or maybe you just feel like your technology is currently holding you back. In today's banking world, overspending on technology is a risk you just can't take. Going up against those major vendors on your own can be tough, expensive, and especially when the contracts are designed to benefit them. That's where Remedy can come in. Remedy Consulting helps our clients stay competitive and grow their business with the right technology, products, and their spending strategies. Not a Remedy client yet? Head on over to remedyconsult.net for a free review of your tech stack, spending, and contract terms. Even if you're not the perfect fit, you'll walk away with expert advice and confidence in your technology decisions. Check us out at remedyconsult.net or give us a call at 262-955-7776. Thanks for tuning in, and now let's get back to the episode.
And so once they opened that up, that allowed for these plans to be able to be applied to the credit unions?
Right.
Okay. All right. So now the CEO goes to the board, says, I'd like this plan, gets signed off by the CFO, gets signed off by the auditor, right?
Yep.
I'm thinking they're exhausted, right? So do they actually go, hey, my COO needs a plan, my CFO needs a plan. Maybe the CFO, maybe you need the CFO to sign on, so you have to have a plan for the CFO as well. But now you get to the COO, you get to the chief lending officer, you get somebody that's another key employee. Does it, is it the entire executive team? When you talked about those stats before, is that the entire exec team, or is it typically CEO and maybe one other and not the entire team? Sort of the gap between when you were talking about middle management and senior management. Who gets it generally? Who's generally?
Well, interestingly enough, the easiest way to get the plan in is for the CEO to get the board to approve it and get the chairman to sign off on it. And usually after going through 3 or 4 meetings on the financial side, the legal documents, by the time the CEO is done, he or she is worn out, as you said. And so typically what happens is the CEO goes down the road and starts getting some pushback from the CFO, and is usually what gives the pushback first. The CFO is giving pushback because the CFO now has seen the CEO's benefit plan, because the CFO is having to book the entries, the debits and the credits for that plan. And so now the CFO is saying, hey, boss, I really would like you to consider us and the middle management. So what has to happen there? Now the person that's the key person is now the CFO. So we would work with the CFO to build a management team that CFO wanted to retain, reward, and retire. And we would take that to the board of the team with the CFO. And once again, like the CFO said for the CEO, there's no cost to this plan. It will be totally informally funded. Now the CFO is doing the same thing. The CFO saying, we're going to add 5 management people on this. Here are the people we're going to add. And just like the CEO plan, this plan is informally funded, and the balance sheet and the income statement will not be affected negatively.
Okay. So it's a long, as far as the board.
So the CFO typically takes the reins and runs with it for his team. And sometimes the CEO will be involved with that, but the CFO does all of the number crunching so that he can present a positive impact to the income statement to the board.
Okay. So, Rick, if an employee leaves and they have not taken the benefit, so they leave early,
right?
In my head, that seems like that would be a positive impact to the bank or credit union because the investment is more aggressive than other ones that they were able to do. In order to get the books right, I would imagine you'd actually have a gain that you weren't really accounting for. Do I have that right?
Yep, you do. And to kind of break it out, you have an asset and you have a liability. When that person leaves, the liability to pay that benefit out is taken off the books, is diminished. But the underlying asset, which is credit union on life insurance, gets to remain with the credit union because it's an asset of the credit union. And NCUA and all the regulators are very comfortable letting the credit union and the bank keep that asset. Now, what they can do with that asset is they can let that asset continue to grow to offset other benefit liabilities, or they can use that same asset and design a new benefit plan for maybe a new executive or a new key manager that they want to recruit to the credit union.
Oh, interesting. Okay. All right. So they can recycle it.
Yep.
Okay. Oh, that's really interesting. Never would have thought of that, but that's great. I would think the board might have a tough time understanding this. Give me one question or two questions that the board's asking because they don't understand all the dynamics. Can you give me a couple thoughts?
Yes, I can. And I get it every time I present this to a board of directors of a credit union specifically. You have to look at the board makeup of a credit union, and you have people that are government employees, you have people that work for the state, you have people that retired from the state. So they're used to looking at these big pension plans that don't exist in credit unions. So their first thing that they're going to say is, well, gosh, Rick, we pay our executives very well and they have a qualified plan. I don't think we need to put a non-qualified plan in. I don't think we need to supplement anything. They've got more benefits than I have. That's typically what is said.
Okay. But if you're working at a utility, you have a pension, which is almost better than a non-qualified to some degree, right? I mean,
Much better.
It's almost a supplemental to some degree because you probably,
That's it.
Yeah.
Yep.
And that's the first pushback is going on there.
Yeah.
So they understand it. They just don't necessarily agree with it because they kind of feel like, I never made this much money in my life. And, this person's making 300.
That's exactly right. And I've seen farmers that are on boards and they can't believe the benefits that are being provided. So it is a big education process. And usually that's done kind of one-on-one with who you think might not understand the way it works. I've gone and sat down with the chairman of the board to explain to them how these plans work. And as long as they understand that whatever plan is in that credit union, there is cost recovery. The credit union is going to recover all of their costs and have a minimum gain. And that's what the rules and regulations provide.
Okay. And I would imagine that the real answer is if it's competitive out there and, people are stealing CEOs,
right?
It is what it is, right? And I think that you'd go back and you'd say, to this organization, we brought in X number of dollars last year.
Yep.
Right. Do you want to keep them coming in or do you want them to fall off? Right. And is it worth X? Right.
Yep.
I mean, that to me is how I'd answer. Not that my answer would be acceptable all the time because, if somebody's making 100 and the CEO is making 300, that still feels like a big enough gap, right? But
Right.
okay. Well, Rick, thank you very much. I think we covered 100% of what I was looking to cover here. Anything else you feel like we should cover?
We need to consider the SERP design, how the SERPs are designed, and then more importantly, which is the biggest question, is how do we pay for this? How do we fund this? How do we do this without an impact to the income statement?
Yeah, great. And I think we can always do that in a future podcast. I think it's great, but for the purposes of our first shot at this, I think we did a good job of at least educating everybody and kind of explaining the who, what, why, and how, more or less.
Yep.
Very good. Well, thank you for joining us on Bank Talk, Rick.
You bet. And glad to be here.
All righty. Thank you. Take care.
Bye.
Okay, well, that's it for Bank Talk. Once again, this is Charlie Kelly, your host. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast brought to you by Remedy Consulting. If you'd like to schedule a call with Rick to further explore SERPs for your organization, please send an email to Mark at maxcher@acumenfa.com. Mark will be able to answer most of your questions and can schedule a call with Rick to learn more about implementing a SERP for your organization. Thanks again, and we'll see you in the next episode.